So good afternoon officially from all of you. I'm Grüß Gott from Vienna. I'm in Vienna this morning, this afternoon, to prepare our Vienna event in September. This will be the last Bauhaus event before the summer. We are very keen to Greenstorm, as Lucina loved to say, with all of you this afternoon. And really, it's a big honor for us to have 4 excellent, prominent speakers representing the different corner of the market. And I will introduce them one by one. But I would like just to share with you before starting a very short reflection on how important has been this debate for the entire community. We are all here to learn from each other, to reflect together, to exchange views, and to understand the point of view of the other person. Today, we try to mix different perspectives. We asked Nicoletta, one of the largest mortgage broker in Italy, to tell us what is the real life, what they see, what are the trends into the market. And she will tell us what is happening on the green mortgage side, but also green loans. I see that EBA is with us this afternoon, and they have a specific mandate on analyzing green mortgages and green loans. So I think this kind of presentation will be very important for all of us, because it's a bit touching the floor and getting to reality. I mean, we are, of course, discussing about green mortgages since years, but it is a really a real check that we are doing with Nicoletta. And then we will be together with Maureen. We will open the perspective of what is happening on the green funding, the green bonds, green covered bonds, how banks are preparing themselves, what are the implications, what are the policy challenges that banks have to tackle when they want to build a green funding line in their balance sheet, how difficult it is, and what are the bottlenecks that maybe can be removed. And then Carmen will help us in understanding how rating agencies are changing, are trying to change methodologies. They are trying really to get a real climate risk thermometer to investors and help them in making a real, I would say, informed decision and impact investment. It will be, I think, the big discussion for the future. And Frank, around 3:30, will help us in understanding how data can help in building better climate risk assessment and strategies internally in the banks, but also how digitalization can help us in managing data in different ways. I think that I don't have to convert a group of converted, because you are all fully on board on our story. But we want to share different angles and trying to understand how we can work together. That's the purpose. It's learning from each other, but also trying to understand how we can build a new ecosystem. As you know, with the with EMF, the Energy Efficiency Mortgage Initiative, we are trying really to build an ecosystem, putting together very different angles and perspectives. It's not easy, but I mean, that's what we are trying to do. Here in Vienna, in September, we will probably do a panel, which we can call, Jenny, maybe the Bauhaus panel, where we will continue the discussion for the first time physically, where we will continue to have the perspective of what's going on into the market from a policy point of view, from a banking point of view, but also from a small, medium enterprise point of view. Because at the end of the day, we are facing a very difficult moment in our history, and we have all the responsibility to bring solution to the European institutions that are working hard to trying to manage the inflation going up, interest rate going up, the need of switching to a transition economy, and all this at the same time with a very dramatic geopolitical situation. So we are part of this exercise. We are part of the democratic process, and we need to step in with good ideas and good proposal and trying to be aligned. That's the role of the EMF-ECBC. Try to align our position. Today, this morning, we have sent our proposal for amendments to the Basel implementation in Europe. And this afternoon, in a few minutes, Daniel will send all our proposed amendment for the Energy Performance Building Directive. These 2 dossiers will change the shape of our market. Probably all of you, when you will be going to ask for the next mortgages, will be impacted by this regulation. So it's very important we move all together as an industry, and we try to build a network that can really propose a solution. With this allow me to introduce Nicoletta. Nicoletta is a great pleasure to have you. As I told a few minutes ago, I think that you are really helping us in understanding what's going on in the market. And if we see a consumer demand, that's the key question. Do we have a real consumer demand? People, when they enter in a branch or they go in the internet, in your case, being a mortgage platform, I mean, they ask for green characteristic, what they are looking for. What are the kind of borrower entering in this space? So I'm very curious to learn from you, Nicoletta, and we thank you for being with us today and for helping us in making this long journey. So allow me to give you the floor. Thank you, Nicoletta, again, for being with us.
Good afternoon, everybody, and thank you very much, Luca, for inviting me. Let me try, first of all, to share the presentation. I think that's quite important. Share.
In case, Lucinda, we can yeah, perfect. Okay. Nicoletta, we see that is a...
Is this working?
Yeah, I can see it.
Perfect.
Thank you.
So again, good afternoon, everybody. My name is Nicoletta Papucci. I'm the Chief Marketing Officer for Gruppo MutuiOnline. I will tell you a little bit about our company in a second, because I guess that most of you don't know it. Today, we'll tell you some, let's say, remarkable numbers about the green mortgage and a few numbers about the green loan market in Italy that we believe are really interesting, and that we were super surprised about them, and I think we can have a good discussion around it. Just a little bit about myself. I've been with Gruppo MutuiOnline for a bit less than 2 years. Before that, I was an associate partner with McKinsey & Company, supporting financial institutions in Europe. So I've been in the market for around 12, 13 years now. As I was saying before, okay, a little bit about Gruppo MutuiOnline. Gruppo MutuiOnline is an Italian company that was founded in the, let's say, edge of the net economy in 2000. And it takes its name, MutuiOnline, which literally means mortgages online, from the first platform and our focus today that was created as an online mortgage broker in Italy. Obviously, the group has grown a lot since then. It reached 93 million EBITDA last year and over 300 million revenues. And it's divided in two main divisions. I would say the other division is providing outsourcing services to various like financial institutions, lenders, insurers in the Italian market, while our focus today, the broking division, is basically managing a multi-brand online comparison platform. So some of you might know, for example, Check24 in Germany, or Comparis in Switzerland, or Rastreator in Spain, Money Supermarket in the UK. We have a very similar approach. We have a multi-brand platform, of which MutuiOnline, our core, let's say, our first and still core market, is our focus today, but we are active in several other markets. Not to brag about our numbers, but just to let you understand why our view of the market is so important to understand what is happening in the Italian market. So through MutuiOnline and through Segugio.it, which is the, let's say, multi-brand aggregator, we have been for 20 years now the #1 brand for online broking and comparison of mortgages. We represent over 85% of the mortgage market in Italy. We are very, very relevant in newspapers, and we publish over 500 interviews, many of which on top-tier newspapers. And we also publish a monthly report that is used by some banks to help define their pricing. So we have a very, I think, significant view of what happens in the market. Just to give you an idea, the Bank of Italy uses our data for some of their studies to add on the data that they can collect from banks. So what I am telling you, what I will tell you next, I think is pretty representative of the overall mortgage market in Italy. Luca was talking about the, let's say, the taxonomy and the importance of a common definition around energy efficient mortgages. We know there is a lot of discussion around it. But what we also know is that since green mortgages have been launched in Italy, which is basically 2019, 2020, all banks have aligned to the same definition. That might change in the future, but at the moment they've all aligned to the same definition, which is pretty clear. It's based on energy classes, and for purchases or new house built, green mortgages are given for houses that are energy class B or above. For renovation, most banks ask you to increase of one energy class, so from E to D or from C to B and so on and so forth. Okay. What I believe, since we are also talking a bit about loans, what I think is very interesting, and I'm not sure if it's the same in other European countries, is that the same alignment in definition is not there for loans. So we also, as I mentioned before, we also have a loan comparison and broking website, Prestiti Online, Loan Online, again. And what we see with our partners is that there are huge differences in the definition of a green loan. So to give you a simple example, for some financial institutions, the loan for a new hybrid vehicle is green. For other, it isn't, because it cannot be hybrid, it must be electric. So I think this is interesting, and the alignment in the definition of green loan of green mortgages might have been one of the reasons why this market has grown so fast in the next few years. Okay, so I'm done with the introduction. I will now get into the numbers. As I was saying, green loans have been basically launched at the end of 2019. Then, as we all know, at the beginning of 2020, we had COVID. We still have COVID, but we had the strict lockdowns that affected particularly Italy. And so we started monitoring green loans from Q3 2020. What did we see? And I was literally impressed by this data. We saw that in less than 2 years, the quotes for green mortgages, so the demand, the number of users who asked for a mortgage throughout our websites, increased by almost 20 times. I think this is impressive. Here we see a peak in Q4 2021 that's given by an even higher peak in November. But even if we look at the overall trend, we have an increase of 14 times. I have never seen such a significant increase for a product in this market. Like literally, it's not an iPhone, it's a mortgage. This is an incredible number, and I will compare it with an initiative that we had that was launched in Italy a year ago to promote, to support young people under 36 to get a mortgage. So the government decided to help under 36 in getting their first mortgage by setting up a series of statal guarantees on one side, and on the other, helping them with lower taxation. Okay. The initiative until a month ago was considered a success, but the numbers tell us that the number of green loans by under 36 doubled. So ×2 was a success. This is ×20. I don't know how to call it. If not, I don't know, a hyper success. Okay. Now let's get into the reasons why we believe that this number increased so much. We think there are mainly 3 reasons. So the first is that obviously in the last 2 years, the awareness and in global interest towards environmental topic has increased. And it has also increased in this market. This is, I would say, the basis for all other reasonments we can do. The second one is that I don't want to bother you with all the Italian legislations and all that, but there was a strong support in the last year and a half for let's say, green renovation, also to support the economy. So part of these mortgages probably are, say, renovation mortgages of people who are using money from the state or are being helped by the state to do green mortgages. And the third reason, from a demand perspective, is the interest rates. So as we see here, if we look again at the same period of time, on average, interest rates for energy efficient mortgages are 20 basis points lower than traditional mortgages. This is true for fixed rates, is even more true for variable rates. So these numbers are basically the average of the interest rates of the quotes on our website. So they're not, let's say, the pure numbers quoted by the banks, but they are the real numbers which the consumer could get their mortgage. This is a mix of 2 effects. On one side, most banks in Italy created green products that were extremely similar to the, let's say, standard product, but had a discount on the rate, had a 10 basis point or in some cases 15 basis point discount. But here we see a higher discount, and the reason is that, as we will see later, consumers asking for this kind of mortgages, for green mortgages, are a bit less risky for banks than the average consumer. So if we look at the number all in all, there is a significant discount, and this might have not been important at the end of 2020 when, as you can see, interest rates were extremely low and the spread between fixed and variable rates was extremely, again, was even too low. But since we saw that in the last 5 months, interest rates have more than doubled, and variable rates will start increasing from the next month again, the impact on green interest rate will be even more interesting. Okay. I saw a question pass by, but I could not read it, and I'm not sure how I can go back to it. Luca, I think you're muted if you're saying something.
I think the question was linked to the fact that Q1 2022, there was a slight decrease in comparison with Q4 2021. So if there was an explanation for this kind of a decrease or...
No, I think this is what we saw, that in November 2021 there was an extreme high number. It's not, there's no particular reason for it, but if we look at the overall trend and not considering that data point, I would say it is still increasing.
It's the double of Q1 of the previous year. So I mean,
exactly.
It's
still increasing. Yeah.
Thank you, Nicoletta.
Now, and now we will look at disbursements. So far we've looked at demand. Let's look now what happens when these loans arrive to the bank and are processed by the bank. What we see is even more interesting. So disbursements have increased by almost 40 times in less than 2 years. Again, here we don't have any outlier, so it's easier to comment. We expect this trend to continue because, as we were saying, the number of quotes has increased, so we expect the number of disbursements to keep increasing. And again, here the reason why this happens is mainly one, which is that the conversion rate for green mortgages is almost or more than double the conversion rate for all other mortgages. And it's increasing. So if it was 1.7 times in 2020, as you can see, it's now 2.2 times. Okay. So what does this mean? This means that banks, on one side, banks are more interested in this consumer, in this potential client. Okay. On the other side, consumers, clients, can afford the mortgage and will be granted the mortgage at a higher rate than let's say the other consumers. I think this number is extremely interesting for both, obviously, financial institutions, because we still see a lot of, especially the smaller banks in Italy, that do not offer this kind of product, but they are missing out on a very interesting market. They are the ones who tell us so. They convert it high. The conversion rate is higher, which means that banks like this product. Okay, but it's also interesting for the average consumer that is looking for a mortgage, because they know that if they ask for a green mortgage, and obviously if they have all the, let's say, checks to get a green mortgage, they are very likely to convert it. Okay. So again, we asked ourselves, but why is this? Why are these numbers so different? And the answer we found was looking at, comparing the characteristics of a green mortgage and the characteristics of all other mortgages, let's say. These are the data from the last 6 months, so it's, let's say, it's very new data. I think that there are 2 or 3 numbers that really struck us in this page. First of all, the average amount of the mortgage is 30% higher when it's a green mortgage. 187k euros is a very high number for mortgages in Italy on average. In the last 10 years, the average mortgage amount has been in between 130k up to 150. It is growing a little bit in the last 6 months, probably also due to inflation, but it never ever reached 187Ks. This is very interesting for a bank. Also because the LTV is lower than traditional mortgages. So this is, let me say, easy. It's more money and less risk. Okay. But who is the other number that's interesting is, say, the applicant income. Here we look at, say, net monthly incomes, which are, you will say, most of you will say this is very low, but it's actually 50% higher than the average income in Italy, which is around 1,400 euros. People who ask for a mortgage, on average, and again, this data has been almost stable for the last 5 years, have a monthly income of 2,000 euros. Quick mortgages, their monthly income is 2,200 euros. It might be only 7 to 8% more, but it is a significant difference. Okay. So what the financial institution, the bank will find is that they are getting a higher mortgage, I mean a higher amount for a lower LTV and a wealthier client, for which probably cross-selling will be more interesting. Okay. So,
thank you, Nicoletta. Maybe since, because this information are really revolutionary, it's our dream. I mean, we were waiting for these numbers for 7 years. So I mean, it's I don't know. Maybe let's go to the map. I mean, you're right. I mean, let's show the map because it's quite also very interesting information.
This is just, it's almost, I would say, almost a fun fact. So I guess that most of you would imagine most green mortgages to be asked in the north of Italy. We did, basically. What we found out is that, interestingly, the northeast of Italy is very attracted to green mortgages, especially the region Trentino Alto Adige, Südtirol, because they've always been, there's always been a very high awareness around these topics. Also because it's very cold, so like efficient houses help. But interestingly, what we find is that also in the center and south of Italy, the incidence of green mortgages is pretty high. And I would almost say that this is a message of hope, let's say, because if the percentage of green mortgages is so, let's say, is almost uniformly spread around Italy, which, as most of you know, is a country that has tremendous differences in terms of salary, I mean, income per capita, and all of that. It means that there is really a lot of interest from any kind of consumer towards this product. Okay. Luca, I leave you.
Yeah, I mean, thank you very much. I mean, Nicoletta, I mean, we will ask you also to come another time because there is also an entire section about green loans, which is even more interesting than this one. Because I mean, the compare. But I would like to propose that we stop here for, and I would like to open the floor for if there are any questions to Nicoletta. Otherwise, Nicoletta, I mean, just from your side, I mean, you see a lot of potential also, as you said, for small banks. I mean, all these numbers happen without a real booster. I mean, nothing happened specially. So, I mean, it was really an auto movement that has been created into the market in the last, I mean, I'm correct in this analysis, or do you see, apart from the super bonus, of course, which was a trigger, but I mean, there is
that's a very good point, Luca. So basically, I mean, say that we haven't done any marketing around it, but nor banks or financial institutions or government has really pushed towards these products. So if we see this growth without any specific communication, any specific marketing and money put on it, we really believe that it can grow even more if we had all these supporting factor, I think.
Thank you, Nicoletta. I mean, the fil rouge of today, it will be the connection between risk and green mortgages. That will be all. We will try to give you different perspectives, but this will be the fil rouge of the meeting today. For us, there is a strong correlation between risk and green mortgages. And the more, I will say, the asset is green, the less is risky from our point of view. And I think that was the line of attack of the Energy Efficiency Mortgage Initiative since years ago. And we are very glad to see these real numbers provided by Nicoletta. Nicoletta, you have a pending invitation to continue your story. So maybe we will try to have you also here in Vienna in the first physical event of the Bauhaus, which will take place around the plenary meeting, because I think that you have a lot to share with us. And we will publish Nicoletta's presentation on the website, but also you will have all the contact details, and we remain at disposal for any question you should have. Thank you very much. Grazie, Nicoletta. And allow me to move to the next presentation. We move to ING. It's a real Dutch bank making the difference in a lot of countries because they have a very international network. I had the honor to share the stage together with Maureen in Busan a few years ago in South Korea, discussing about ESG. And it was really a pleasure. I mean, Maureen is really helping us enormously in disseminating and spread out the ESG religion. And he is really writing a lot of articles in the fact book and in other publications. And we are very glad to have Maureen with us today. Maureen, allow me to give you the floor and to guide us in the world of the green bonds. What is happening over there?
Yes, thank you, Luca. I'm not sure because I think my video doesn't work, so I will quickly be sharing the presentation. So, can you see it?
Yes, perfectly.
Okay. Perfect. Now I need to go to the presentation. Yeah. Okay. So what I would like to share today is actually a little bit of an overview of how all the ESG regulation is impacting actually the sustainable covered bond market. To me, I always find actually everything that is happening on the regulatory field a little bit overwhelming, as all of you probably try to keep your head around everything that is happening and evolving in terms of the regulatory landscape. I try to do the same thing myself, and I hope actually with today's presentation I will give you a little bit of a summary of some of the regulatory elements without being complete here. I immediately acknowledge that. But before I do so, we thought to give a little bit of an update on where we are today, where it comes to actually sustainable bond issuance. So the financing of sustainable growth by means of banks printing sustainable covered bonds, or be it senior unsecured or subordinated bonds. Now, what you can nicely see is actually the jump, particularly in 2021, where it comes to sustainable bank bond supply. We have seen almost a duplication across the different bank bond segments where it comes to the sustainability print. And one of the factors that explains this jump, in my view, is also the clarity that was obtained regarding the technical screening criteria under the Climate Delegated Act. Now, if you look at this year's covered bond, sustainable bonds print, you see that it's actually falling a little bit short in comparison to the first half of 21. But you also immediately see that in covered bonds, the print is a little bit higher than it was during the first 6 months of last year. Now, if you move to the second picture, you see the main explanatory factor that is obviously driven by the fact that we have huge increase in the bond supply. Year to date, we are almost already hitting 120 billion. But if you look at the share of the sustainability bond market print and covered bonds, then you see actually that it has dropped to only 9%. So despite the fact that we are seeing an increase in sustainable covered bond supply this year, as a share of the overall print, it is still relatively modest. Also in comparison to the other segments, preferred senior, bail-in senior, also subordinated issuance, we have seen a decline in the share versus the overall print everywhere, but not as significantly as we have seen on a year-to-date basis in covered bonds. So that illustrates that the covered bond market sustainability issuance, remains a little bit lower in the overall print than for the other bank bond products. There are a couple of explanatory factors, obviously. Think of the greenium, which is the difference, obviously, between where the green bond is issued or the sustainable bond is issued versus the vanilla curve of the issuer. It tends to be tighter in covered bonds because covered bonds have tighter spreads than preferred senior, bail-in, loan bail-in senior unsecured instruments. Another explanatory factor is obviously also that issuers generally would strive actually to have sufficient eligible green assets also dedicated in the collateral pool. So that also obviously means that the sustainable portfolio not only has to meet the requirements, the eligibility requirements for the sustainable bond portfolio, but also the eligibility criteria applicable to the covered bonds. Then if I move to the next picture, you see a nice overview, particularly regarding the distribution, green and social use of proceeds. What you see here is that particular in the non-covered bank bonds, the green use of proceeds are very dominant. In covered bonds, they are also quite dominant, but a little bit less than in the unsecured segment. And here you see also another important explanation, I think, where it comes to why probably the issuance in, let's say, green covered bonds as a share of the overall print is a little bit less than in non-covered segment. That is, if you look at the use of proceeds, obviously because of the characteristics of covered bonds being primarily secured by mortgage loans, you see actually that the proceed use in the green segment is mainly dedicated to green building loans. Now you actually also see that in the non-covered segment, quite a substantial part is used for financing green buildings. So if banks issue actually green bonds in a non-covered segment to finance green buildings, that obviously also cannibalizes assets in the eligible green portfolio that could otherwise have been used for green covered bond issuance. Now you can also see actually that for unsecured bank bonds, also the renewable energy component is quite substantial, and particularly this substantial component is also one of the major explanatory factors why in general you would see green issuance being more dominant in the non-covered segment than in the covered segment. Now, with the EU Green Bond Standard, we will obviously see that that the bar will be raised for issuers of future European green bonds. Particularly when it comes to the use of proceeds, one of the important elements is, of course, that these proceeds have to be taxonomy compliant. Besides that, also these bonds will be subject to mandatory review, for instance, of the green bond fact sheet, and this mandatory review is a little bit different than what we see currently being the voluntary use of SPO. So this all in all means that, particularly for the covered bond segment, it is quite essential if you want to be fully taxonomy compliant, that first of all, you meet the technical screening criteria for substantial contribution. I think to most of you, these criteria are quite familiar in the sense that new constructed buildings have to meet the primary energy demand criteria of less than 10% below the nearly zero energy building requirements. Buildings acquired before the end of 2020, they need to have an EPC label, at least in the class A, or alternatively have to be within a top 50%. Elsewhere, in terms of transitional measures, we have the building renovations as being one of the eligible components. Here it's important as one of the elements that a reduction of the primary energy demand is realized of at least 30%. Now the chart on the right gives a little bit an overview of a chart that we also use for the ECBC fact book on where covered bond programs are. And what you see from this chart is actually that most of the covered bond programs would meet these technical screening criteria for substantial contribution, primarily on the 15% best in class criterion. Not so many will do so on the EPC label of A, although if you look at the green bond frameworks and more recently launched green bond frameworks or more recently updated green bond frameworks, you increasingly see the EPC criterion of A getting introduced in the framework. However, to be taxonomy compliant, it is more than just meeting the technical screening criteria for substantial contribution alone. Issuers will also have to meet the do no significant harm criteria. For instance, to name an example, on the do no significant harm criteria for climate change adaptation, it would actually mean that the issuers would have to perform a climate risk and vulnerability assessment to address or to see where the physical risks are in terms of flooding or wildfires. And if these are present, they have to come with an adaptation plan. Now that is an additional challenge on top of just meeting the criteria for substantial contribution to one of the environmental objectives, and on top of that also the minimum safeguards have to be met. So it's more than just meeting these criteria, but if you look at how issuers currently approach it, then you see actually where it comes to giving an indication of the taxonomy compliance of a green bond framework, that the most important focus at this particular point in time is actually on how the performance is on meeting the substantial contribution criteria. Now, why is it so important to be taxonomy compliant? I would say it's not so much purely of importance to green bonds alone. It is important on an issuer level, but also for the issuer's vanilla bonds, not only for bonds that will be marketed as European green bonds in the future. That is because the taxonomy is actually the center point, I would say, of the whole EU sustainability reporting regime. That means actually that where it comes, for instance, to the non-financial reporting directive, and the requirements are that listed companies with an average of 500 employees or more would have to report on the taxonomy compliance. That these criteria will be expanded with the Corporate Sustainability Reporting Directive, where I understand that actually yesterday a provisional agreement was reached between the Council and the European Parliament. Under the CSRD, actually these disclosure requirements will be expanded to all large corporations and all listed corporations, except for micro companies. Now, on the other hand, these taxonomy, meeting the taxonomy requirements is also important for the sustainable finance disclosure regulation, where financial market participants, such as portfolio managers, also have to give insight in how they perform on different ESG aspects, and taxonomy compliance is one of these elements. Now, as we have seen here, that for the purpose of the non-financial reporting directive and the taxonomy KPIs that are applicable there, that's actually disclosure they apply to large corporations and all listed corporations. So that means essentially, I will go back to that slide in a bit. That means essentially that certain small and medium enterprises are still excluded from the taxonomy KPIs. And that is actually where the Pillar 3 disclosure proposals of the EBA come in, because the EBA actually introduced banking book taxonomy alignment ratio, which on a best effort basis also allow banks to give insight actually in their exposures, in the taxonomy compliance of their exposures to non-financial corporations that are actually not subject to the NFRD disclosure requirements. Now, why is all this of relevance? Now, here you see actually an indication of how these taxonomy-related disclosures or meeting the EU Green Bond Standard requirements will be of importance to investors. With this little picture, it shows, for instance, that an investor or a portfolio manager that has to report on the taxonomy compliance of its portfolio would actually have to look at bonds in different ways, like an EU green bond, because it is 100% taxonomy compliant, could also count for 100% in the taxonomy disclosures of the investor. Other green bonds, so those that are not marketed as European green bonds, could only be recognized to the extent that they actually allocate proceeds to environmentally sustainable activities. So only to the extent that they are taxonomy aligned. But importantly, also for vanilla bonds, taxonomy alignment, but then on an issuer level, is quite important. Here, actually, the investor would look at the taxonomy KPI disclosed under the non-financial reporting directive, for instance, by the bank. So the green asset ratio of the bank would actually be important on how and to what extent an investor can recognize a vanilla bond under its own taxonomy KPI. So that actually also shows that for investors, it is quite important how a bank will score green asset ratio, because if it invests in a vanilla bond of a bank that has a high green asset ratio, that will also reflect positively on its own taxonomy KPI. So this, in our view, is also a crucial picture where it comes to what would be more important to an investor. Is it actually the green asset ratio, or is it actually the BETAR? We believe that because investors will primarily have to incorporate or weigh, let's say, vanilla bond exposures of banks by means of the green asset ratio, that the green asset ratio will, in terms of importance, remain actually dominant over the BETAR for investors. Now, that was it a little bit on the liability side. One of the other regulatory developments going on is actually the proposals by the EBA with reference to green securitization notes and how they should be incorporated under the EU Green Bond Standard or EU Green Bond regulation. One important thing to bear in mind is that the EU Green Bond regulation takes actually a use of proceeds at this particular point in time, and actually is focused primarily on the issuer. Now, in the case of a green securitization note, a true sale securitization note, assets are transferred to an SPV. That means that the issuer is actually the SPV, the issuer of the securitization note. That would also automatically mean if you would apply actually all the requirements from the green bond standard on the level of the SPV, that would mean that actually the assets in the SPV, so securing the securitization note, would already have to be taxonomy compliant at the moment of issuance. That means that the issuer would need to have sufficient taxonomy compliant assets before it issues a securitization note, and that would actually also prohibit securitization notes to be used for one important element, namely for the generation of new green assets. So to avoid that particular element, and also to make sure that actually the entity that has to report on how the proceeds are used, it is actually the EBA proposes that for the purpose of securitization notes, you would look actually at the originator of the assets. So that essentially could mean that you could issue a green securitization note while the proceeds of that securitization note are used to finance assets meeting the taxonomy criteria that are actually not segregated in the SPV, so not securing the securitization note, but stay on balance sheet of the originating entity. Now, for covered bonds, the story is a little bit different because if you look at a very simplified model, then the covered pool securing a covered bond is a dynamic one. So a covered bond is also a dual recourse instrument. But all in all, it means that if an issuer would actually originate a mortgage loan that meets the taxonomy criteria, it could also potentially currently issue a covered bonds financing actually new assets, and still at a later stage, also because the covered pool is dynamic, allocated to the covered pool. So the story for covered bonds is a little bit different than for securitization notes, but the EBA in its report does highlight that to the extent that also in the case of covered bonds, a different special purpose entity would be used for the issuance of covered bonds versus the originator of the mortgage loans, that along the line of the proposals for securitization notes, that should actually also apply to covered bonds.
Thank you, Maureen. Maybe allow me to step in here also, because we as ECBC, we are creating a specific working group on green covered bonds. So I mean, actually tomorrow we will have in 2 days time, we will have the first meeting in Frankfurt where we are discussing about this group, where you are part, of course. And also the European Commission, for what we understand, is focusing the attention to the green covered bond market, which was a piece missing in the directive. It's the only piece which was missing in the directive. So we as an industry, we want to pay attention. Allow me to interrupt, because there was a question from Ivan Lavastra from Caisse des Dépôts. Ivan, feel free to raise your question directly, but I mean, you were asking if there is space for renovation mortgages in the pool for covered bonds. That was the question for Ivan, but I mean, please feel free to articulate your question better.
Sorry?
Yeah, I mean, Ivan...
Ivan, would you like to ask the question yourself?
I think we have lost Ivan.
Yeah, of course. Actually, that is one element I would like to discuss in the next couple of slides, if that is okay. Because well, let me just move to the next couple of slides. I think there are two important developments at this particular point in time. Luca, you already mentioned it earlier on in the meeting. One is the Energy Performance of Building Directive, and which is actually stepping up the requirements where it comes to renovations. And yes, I think these renovations could also play a very important role where it comes to the financing or where it comes to covered bond issuance. To name a very simple example, so if you look at the Energy Performance of Building Directive, it has a couple of crucial elements that I think are also quite important for covered bonds. One of them is, of course, the harmonization of the EPC label scales. So by the end of 2025, across the different jurisdictions, there should be a harmonized scale, meaning that an APC label A would be used for zero energy buildings, for zero emission buildings, and an APC label G would classify or mark actually the worst performing 15% of the mortgage stack. A second important element is actually the improving the availability of EPC labels. So that means actually that if a building gets renovated, it is also required as a new element here that it should obtain an APC label. Also, if a building is rented, if it's rented to another person, it should also coincide with the availability of an APC label. National jurisdictions are required to make up an APC a database for APC labels, so that actually means that there will become better insight in APC labels, which obviously will also be important for the covered bond market, because it also allows the covered bonds market to identify, I would say, more mortgages that have, for instance, potentially the APC label of A, and would for that particular reason be taxonomy compliant, but also the incentive that is provided by the EPBD in terms of renovation. So let's say if you look at the chart on the left, so for existing residential buildings, like by the end of by 2030, these buildings should no longer be allowed to have an APC label of G. 3 years later, they should no longer have an EPC label of F. And if you want to move actually to the 2050 requirements that actually the whole building stock should have an APC label of A, it means actually that every 3 to 4 years, one of these EPC labels have to be removed. So buildings have to be renovated to move to a higher EPC label. That also means that actually over time the stack of assets that are eligible for the purpose of green bond issuance or issuance under the EU green bond standard, that it would actually improve. That is one thing, and obviously green covered bonds could also play a role in financing these building renovations, right? So it could also definitely give a positive incentive to the future issuance of green covered bonds. Having said that, and Luca, I think with the memo that the EMF-ECBC will send out tomorrow, if I understand you correctly, there is also a risk, of course, involved, and that is with reference to properties that are not meeting the deadline. So that obviously, if you are not able to move up in the energy efficiency class, it could have quite a negative impact on the value of the property involved. So that is definitely also an element to keep an eye out for. But I think in general, the trend that the recap of the Energy Performance and Building Directive aims to achieve is one of the building stock becoming more energy efficient. And I think that has also certain developments where it comes to the future evolvement of the green covered bond market. Final element I wanted to discuss here is actually also the expansion of the taxonomy regulation, for instance, for significantly harmful activities. A few months ago, the platform of Sustainable Finance came with its final proposals on how such a significantly an extension or expansion of the taxonomy regulation for significantly harmful activities should look like, where it identifies actually 3 subclasses. Green is what is currently taxonomy compliant, so offering a significant contribution to the environment. Whereas the red category is the unsustainable or significantly harm performance level. And there, the very interesting element in my view is actually the proposal that the platform of sustainable finance says you should actually look at the current do no significant harm criteria to identify what is actually also a significantly harmful activity. Now, if you look to the building criteria or the climate change adaptation criteria for buildings and look at the do no significant harm criteria for the climate change mitigation objective, you find actually, where it comes to buildings that are built before the end of 2020, that it would mean that anything with an EPC label of D or lower, or anything not belonging to the top 30% most energy efficient buildings, would actually be classified as being significantly harmful under such an expanded taxonomy. Now, similar as with actually the energy performance of building directive, also here, I find the use of a percentage actually quite difficult. So I think you would actually also need further clarity or a cutoff date, at least for application of a percentage, because otherwise you could have, let's say, a building transition away from the significantly harmful part towards, let's say, an intermediate performance level or to a significant contribution level. But that would also mean that another building would enter that lowest 70% again. So I think that it should definitely have a certain clarity of when you would identify that percentage being applied. And I hope at least, well, one other element to mention from this one is actually that the do no significant harm criteria do actually differ from the principal adverse impact definition of inefficient real estate assets, where actually inefficient real estate assets are classified as having an EPC label of C or below. So it will also be very interesting to see the discussion on what is actually significantly harmful evolve. But I think both of these regulatory initiatives will set a trend in terms of giving a push to renovation going forward. And I think that the covered bond market, in terms of financing such renovations, could play a role indeed. I hope that is a long answer to your short question.
Thank you, Maureen. I mean, your presentation is really helpful, and I would like just to recall that all the presentation will be available on our website. While we were speaking, and we are sending our response to the Parliament, so sorry for the noise of the emails, but the Parliament has been bombed with our response. Of course, we fully support the renovation wave, but we are asking also the European Parliament to be very careful to the social impact of an aggressive strategy. As you know, the rapporteur has even shown more aggressive numbers in letters that what you have described, Maureen. So we are very concerned that we could have a serious social implication, arbitrage for people, fragile people, that can be created into the market. So we are here to support and to create an ecosystem which will be smooth, but it's all clear to us how important is data and definitions. So taxonomy compliance, do not significant harm, those definition will have a huge impact on how banks will finance themselves in the capital markets and how they will pay capital charges and provide disclosure to authorities, but also to investors. Thank you very much, Maureen. It's been a great pleasure to listen to you. Now let's try always remaining in the data remit. Let's remain with the rating agencies. I think they are playing another extremely important role. And it's an honor for us to have Carmen with us, who is really supporting us in our analysis and our reflection. Thank you, Carmen, for being so close to our discussion. The floor is yours.
Thank you very much, Luca. Thank you to the ECBC and the EMI for inviting us to explain our journey with ESG and how we're moving forward, moving from the credit rating side to the pure ESG rating side. And I think, all this is very important. And I just want to thank Maureen as well, because I think everything she said is very pertinent to everything I'm going to be saying. And it is very difficult actually to summarize everything Maureen said. And I think she did it excellently. And you'll see in a minute as I go through my slides how I will refer to some of the points that she raised over there. So let me share my screen first of all. Okay, so I'm going to go into the slideshow mode. Okay, so yeah, I've titled this presentation ESG at Fitch, Impact and Financial Materiality, and you'll see in a short moment why that's important. So I'm Carmen Muñoz. I'm the head of risk for Sustainable Fitch. You probably all know me from Fitch Ratings. So early in January, short of turning 30 years with Fitch, I was offered a new position as the head of risk. And my first mandate has been to build up a team of analysts to actually conduct the ESG ratings analysis, the pure ESG ratings analysis. So it's been a nice shift for me after very many years with the credit rating space. So today, I will be talking about the product offering that we have, so you can put things into perspective, the whole idea of financial materiality versus impact, ESG relevance scores versus each ESG ratings, which is essentially that, the different rating scales we're using, and the fact that we have a modular approach to our ESG ratings. Okay, then it's quite interesting because the approach that we have to ESG is quite different between secured and unsecured debt. And this goes back to what Maureen was saying earlier, because assets to us are very important when we're looking at secured debt. Okay, and we would include over there covered bonds, as well as asset-backed securities. Then I'll go over some case studies just to illustrate a lot of the theory I bring in. And then there is additional material in the appendix, and I won't go over that in depth because you can just look at it freely. For any more information, I have put the link to our website over here, so feel free to use the link. There's lots of material for all of you to enjoy, I was going to say. So where are we with ESG in terms of the Fitch Group? So in the left-hand side of this chart, you will see that we began our journey in 2019, assigning ESG relevance scores, and this is very closely linked to how ESG factors would impact our credit rating decisions. So it was a bit backward-looking because we were looking at how it affected us in the past, and now for each and every rating action we're doing, we're actually bringing that up to date, and we're reflecting whether a particular ESG factor has affected the ratings or not. In the next column, we have the vulnerability scores, which essentially go a bit longer term, and they try to portray how climate change can impact on enterprise value, and that we're looking at 2050 and a 2-degree, we're limiting climate change to a 2-degree warming. But the idea over here is really to see how a company value can be affected, can be impacted from now until 2050. And we started first with the energy sector, and now we're rolling this out to different sectors that we cover at Fitch. In the center part, we have thematic research. This is, I think, necessary. It's necessary for us to understand what's going on in different sectors, in different markets. And we try to look at this globally. And the idea over here is that anything that we produce from ratings can feed into research and vice versa. Anything from research can fit into ratings. So essentially, this presentation will be talking about ESG ratings. What are ESG ratings for us? Well, it's an analytical tool which enables the market to see the ESG quality of a particular issuer and a particular bond. With that said, we have three main pillars, which are the ESG rating in itself, entity rating, and later we compare this with its peers. We also have the framework rating, and the combination of the entity rating and the framework rating will produce what we call the ESG instrument rating, which is ISIN by ISIN. So, we will have different levels of information. It's a modular approach, so you'll have an entity rating, a framework rating, and with some filters that magnify any potential good or bad features of a green bond, that will then produce your instrument rating. So in simple terms, if we look at what we're trying to portray over here, so the ESG relevance scores, we're looking at financial materiality. And in terms of the ESG ratings, we're looking at impact. Okay, the key focus is impact. We know that at the moment we're trying to build up coverage. So we're attacking, or we're more than attacking, we're covering currently the labeled bond universe, meaning all the green, social, sustainability linked, and sustainable bonds that are in the market. We're working towards that with a full launch expected sometime this year. And what we're trying to do with the ESG ratings is essentially look at it purely from an ESG perspective. So we want investors to actually look at our credit rating reports and look at our ESG rating reports, and in both cases be able to put into perspective the financial materiality and the impact element, or how green, how social a particular bond is, and how the governance is. And so the combination of the both will give an investor more information, greater transparency on so that when they have to make decisions on assets or investments, they can actually do so in an informed manner. So this is our key goal. We want to make sure that the same rigor that we've always used for our credit ratings will be used in our ESG ratings. So it's one of my main missions within Sustainable Fitch, is to ensure that we apply the same elements of analysis and the same policies and procedures as we do at Fitch Ratings, mindful that in the future we are likely to be regulated for the ESG ratings as well. So just to sum up, in terms of relevance scores, this is a little map that shows you what we look at for relevance scores. They all seem pretty similar to what we would look at the ESG ratings. Then the color coding over here is essentially focused at different asset classes or different types of bond issuances. So our focus on corporates is different from the focus that we have on sovereigns, for example. So we've had to adapt that a bit more and make it more intelligible. So what do the rating scales look like? From the ESG relevance score perspective, we're saying we have from 1 to 5, where we say 1 is irrelevant to the ratings and the sector, 2 irrelevant to the ratings and relevant to the sector, and that goes all the way to 5, where a particular ESG element is actually a key rating driver. More often than not, what we've encountered is very seldomly has environmental elements impacted on our rating decisions, in our credit rating decisions. In social, they have at some point, and I'll give an example of that later. But where we've seen most impact to ratings has been actually in the governance angle. And the governance angle, because bad governance actually has had a big impact on financials of companies and on enterprise value. For the ESG ratings, I'm just including that of the instrument rating, which, like I said earlier, is the combination of the entity and the framework rating. Again, we have a rating scale of 1 to 5, but in this case, we also have additionally a more granular scale with the aim of ensuring that we can compare different companies or different instruments in a more granular way, so that number one is translated into 100 to 8, from 87.5 to 100, and as we go down. But again, 1 is the best rating and 5 would be the worst rating. So very similar to what we see in ESG relevance scores, except for the fact that in ESG relevance scores you can actually have a positive impact. Okay, so that the impact on the ESG relevance scores is positive and negative, meaning that if you have a particular bond which is actually a social bond and there's a very it impacts very positively on the enterprise or the company or a transaction, we would then put a plus over the 4 or the 5. Going deeper into ESG ratings. Okay, yeah. Before I go deeper into ESG ratings, I wanted to give this example, which I thought would help illustrate what we're doing. Okay, and it'll help frame my next slide. So I have an example over here. It's not ING. It's a Dutch. It's the equivalent of a Dutch, a hypothetical Dutch covered bond. Okay, issued by a bank called Global Bank. Hypothetical again. So this is the first covered bond issued of about 500 million euros, with a cover pool of 600 million and a mortgage book of 50 billion. Okay, now, sorry about this. So 60. Let's say that 60% of the mortgage cover pool has an EPC of A. Okay, and then 40% of the mortgage cover pool also has an NHG guarantee or enjoys an NHG guarantee, which is a guarantee given by the Dutch government for a certain level of amounts. Okay, and 35% of the mortgage book actually has an EPC of A. So the difference here is that we're saying that 60% of the mortgage cover pool has an EPC of A, whereas 35% of the total mortgage book has an EPC of A. Okay, so what we're saying is that cover pool is very green in a sense. So if we approach it from ESG relevance score perspective, how would we frame this? So far, we have not been able to have empirical evidence that because you have an EPC of A, that particular mortgage book is better performing than that with an EPC of E or D or whatever. Okay, so what we've done so far is we have been able to prove that with an EPC with an NHG guarantee, the actual mortgage is better performing than than if it did not have an NHG guarantee. So therefore, under relevance scores, we positively gave credit to it. So we have a 4+ for human rights, community relations, access, and affordability, indicating that that has had a positive impact on our rating, and more than on our rating, it has had a positive impact on the levels of OC required under our stress scenarios. So this is quite interesting. Now, if we look at it from an instrument rating perspective, what's quite interesting over here is we would view very positively both elements. We would view very positively the fact that the mortgage book, a large proportion of that has an EPC of A of the mortgage cover pool. So therefore, it's highly likely that we would achieve a score of 1. And then we have an add-on over here. Because we're looking at the secured debt, okay, we would also have to analyze the assets. And upon analyzing the assets, we see effectively that a large proportion is aligned, first of all, with EU taxonomy. And in terms of social, we would most likely score it a 2. This is possibly because there's just a slight limitation on the availability of those mortgages. It's not available to all. We have to make sure that there's some sort of social drive behind it. But in any case, it will still score very, very highly. Okay. So in this case, from an instrument rating perspective, from ESG instrument rating perspective, we're looking at the very high score. And if we're looking at it from a relevant score perspective, we're just factoring in the social aspect of it. So I hope this has clarified things a bit for all of you. Now, so what does our framework look like? So I was talking about the entity analysis, and I was also talking about the framework analysis. So in terms of the entity analysis, we look at entity information, and here you have the proportion or the percentages of how this contribute to the score. So with the entity information, we're looking at 10%. And what's really the key focus of our analysis in the entity analysis would be the business activities of a particular company. Okay, so we'd be looking at, how social, how environmental are those business activities, and what's the governance behind that. That would then produce what we call the ESG entity rating. To the left side, we have the debt instrument structure. So we have GSS, which is green, social, and sustainability bonds, and later we have sustainability-linked bonds, and we also have conventional bonds. Okay, so within the GSS element, we would be looking essentially at the use of proceeds, which is quite similar to what the whole thing of business activities is transposed into use of proceeds for a typical bond framework. This should possibly sound very familiar to most of you because we're using the ICMA green and social bond principles to actually come up with how we analyze these bonds. So we would look at the use of proceeds, which is 40% of our weighting. Then also do project evaluation, and selection, management of proceeds, and reporting and transparency. KPI, we would essentially look at the KPIs, their performance targets, how ambitious are those targets, and whether those are really furthering, I would say, a greener world or a more social world. And so that would also give us a framework rating, but specifically for KPI. Then there's another area, which would be the conventional bonds. This would essentially be what we would call, we would do structural analysis of the framework, and the bond structural analysis will, you might have a bond over here, for example, which is not very green, but there are elements of it within the unsecured space that lead us to believe that there is some greenium in that. So we would analyze the documentation and come up with a documentation assessment. So the result of this, we would provide 5 filters that would magnify either the strength or the weaknesses of each of those, I would say, use of proceeds or performance targets. And the combination of this and the entity rating would give us what we call the ESG instrument rating. And the way this plays out is, let's say you have an energy company where the entity rating side would be quite negative, but the bonds are KPI linked, or they're green bonds, and those bonds are used for a certain investment or a certain activity within renewables. That would then give you a higher, or it would bring up your entity rating so that your instrument rating will actually be much better than what you would have had in your entity rating. Now, going quickly into the covered bond space or asset-backed security space, we have an additional layer over here, which is asset review. Okay. And how will this look like then? So if we're looking at unsecured covered bonds and structured finance, for unsecured and covered bonds, we do an entity analysis. Obviously, for covered bonds, we do that because it's a dual recourse instrument. For structured finance, there's no recourse to the originator, therefore we don't do any assessment on that. But For all, we do what we call a framework analysis. So in some cases, you would actually find that some issuers have a different framework for secured and another framework for covered bonds. So it's quite interesting that all this is evolving as we speak, but it's quite interesting that we can distinguish between the two frameworks. In the case of unsecured, we would end our analysis with a framework analysis, whereas, like I mentioned earlier, we do an asset analysis for both covered bonds and structured finance. Okay, so I'm conscious of time. So we're still okay. So just in this part of asset analysis, what do we actually look at? Okay, so we're looking at the environmental or social nature of the assets. Are the assets contributing to the general environmental and social goals? Then we look at the tracking method that they have. And this for us is very relevant because we want to make sure that the investors actually have access to those green or social assets. Okay, so it's not, when we look at covered bonds, we're saying, okay, they have a privileged situation, they have a privileged claim to those to those mortgages. But what we want to see at the same time, do they have a privileged claim to those green assets, okay, or to those social assets? So we look at the quantity of the GSS assets within a particular structure and see what percentage that is of the total. We also look at the fact that are there any substitution clauses, meaning that if some of these assets amortize or lose their greenness, are they able to substitute them with a similar instrument? And then finally, we would look at the cash balances and to see that are they invested in assets which are very similar to that for the whole framework. Okay, meaning that are they invested in bonds, for example, in green bonds, even if they're sovereign green bonds? So that would give us, better comfort that the whole structure is quite bulletproof and quite, I would say, it's very focused on that green and social perspective. Okay, so just to give you an analysis, this actually is a chart which I would have loved to update, but I wasn't able to update it. We got this information from last year, and all this information is taken from the ECBC statistics. Okay, and then there's a difference between the text in red and that in black. The one in red means that we've been able to find the assets, the earmarked assets in HTT. The HTT for us is a very important, I would say, document because it speaks towards, how I would say it speaks towards the transparency that there is, and it speaks towards the voluntary nature of a particular issuer to explain the assets that they have in that portfolio. Because, like I said, the asset analysis is an important part of our ESG ratings for covered bonds and ABS. Okay, so just to give you an idea, like we were saying, or I think we have spoken about this in previous panels, and what it is that there is really a lot of earmarked assets out there. They're still lacking, but there is quite a number of earmarked assets. There's less issuance and more assets out there. So I think that's one of the interesting things that we actually were able to uncover with this study is we saw that pretty much there is capacity to issue more green bonds out there or social bonds out there. I think in this case, we're looking in all cases at green bonds, not at social. But there are social bonds out there, with the Korean Housing Finance Corporation, etc. So, and if you look at the Swedish Covered Bond Corporation, I think it's just amazing to see that the earmarked assets are actually quite a lot. But we also have to remember that they do follow the matching principle over there, and so the fact that they follow the matching principle, makes that ratio quite elevated compared to other I would say financial institutions. But I think it's quite this chart is quite interesting, and thanks to the information we were able to find in the ECBC, this was helpful in putting all this things into perspective. Okay. And I'm almost finishing. It's just one case study I'm going to bring up over here. So just so you see how we actually conduct our analysis, this would be a real estate company, which we can liken it to what we have for a covered bond. So in this, we see that in terms of the activities that they have, in terms of the turnover, sorry, the business activities, they have green building certificates and old buildings is 35%. They have top 15%, or EPCA is 10%. Construction is they have 10% improvement in PD versus NZTB, net zero, okay, and that would be 15%. So, summarizing this, how would we put this into perspective for ESG rating for this particular real estate company? Taking into account the different things that Maureen referred to earlier, which was technical screening criteria, and the do no significant harm criteria, as well as the minimum safeguards. Okay, 65% of the score will be determined by what we would call a taxonomy anchor score, because when we give ESG ratings, we actually go back to the EU taxonomy. We inspire ourselves with the EU taxonomy, and for social, we would inspire ourselves with UN Sustainability Development Goals. Okay, so 65% of the score will be determined by a taxonomy anchor score, because over here you have quite a lot of assets which are actually compliant with the technical screening criteria. Okay, and then 35% will be based on an internal sector assessment, and we would actually adjust our scores based on those certifications, trying to understand them a bit better. Okay, so I think I will stop over here. If you want any more information, feel free to reach out, and you'll have this presentation available for you. So feel free to reach out for anything you need.
Thank you, Carmen. I think that it was very clear from your presentation the importance of the data input. I mean, all the banks, and you've done a nice example in the Netherlands. I don't want to make any compliments to Piet Hein, who is in the phone. I mean, the Netherlands is quite a paradise for transparency and data access. The question is how we can help banks in improving the mortgage portfolio, data point, and with access to APC, very challenging. And sometimes when we speak with the Parliament, for example, when they speak about mortgage portfolio standard, we are very concerned because we recall to the European Parliament that banks, they don't have buildings in their portfolio. They have loans, which is a different concept, and the information has to be transferred. So sometimes it seems to be that there is a kind of a confusion. But I mean, here I think is a perfect space for Frank to step in and to help us to understand how the IT challenges can actually be addressed by mortgage lenders, and how we can facilitate the work of rating agencies by providing the basics, which is what are the data behind a loan. Thank you, Carmen, and allow me to welcome Frank. Thank you for being with us. And for helping me to keep gender balance in this panel. Thank you very much, Frank, for being with me today. We always try to keep good balance between geographic and gender and whatever, and also stakeholders balance. All the balance, all possible balance are met in the ECBC and the EMF. We try to do our best. Thank you, Frank, for being with us.
Thank you. And thank you, Luca, for the invitation today to you and your team. I will just share my screen. Let's see if I can do that. Just bear with me 1 second. So can you see that? Yeah, okay, perfect. I'm just going to start my presentation, if that's okay. So, good afternoon. My name is Frank Wall, and during my presentation, I will be showing you how we apply proprietary and third-party mortgage data to better manage climate risk through our mortgage analytics platform, Incol Intelligence. So I hear you ask, what is Incol Intelligence? Incol Intelligence is an interactive, scalable, cloud-based mortgage analytics platform. It is a secure, push-button, web-based application and is available to multiple internal and external stakeholders. A user simply logs in and chooses a portfolio from a drop-down list. The user can then analyze that portfolio in its current status and/or track how the portfolio dynamics have evolved over time. Starting at the asset level, the platform uses a bottom-up approach, aggregating to the portfolio and overall business level. Using both proprietary and third-party public data, Incol Intelligence visualizes mortgage portfolios like you've never seen before. And as a single source of truth, that is, one upload ensures consistent use across all stakeholders. So as a single source of truth, it facilitates enhanced risk management and informed decision-making to help identify opportunities and create value business-wide. So how does it work? The platform has been designed to make it really easy to use. The user simply uploads its data through a Bank of England mortgage template or an ECB mortgage template or even an ESMA mortgage template. The business can control the interval of portfolio uploads to suit their needs, be it monthly, weekly, or even daily. Alternatively, the user can invoke Incol's APIs to automatically push data for analysis instead of uploading portfolio templates manually. Once uploaded, Incol Intelligence immediately identifies any errors through its validation and consistency checks on the relevant uploaded data. The platform then applies climate risk management data and seamlessly integrates this with client proprietary data. Incol's third-party data service providers have opened their APIs, allowing Incol Intelligence to invoke and fetch the relevant public data. This integrated data is stored in a ring-fenced, secure, scalable repository for immediate or future use. This complete dataset is then harnessed, portray the portfolio dynamics through a series of interactive dashboards and exception reports, which I'll show you in a while, allowing the user to explore, model, and interpret the data with confidence. All output can be exported to Excel, PDF, PowerPoint, .csv, and PNG for distribution and action across the business. Why choose our mortgage analytics platform? Incol Intelligence has been built drawing on Incol's in-depth knowledge and experience across financial markets, together with its engagement with multiple stakeholders across the mortgage sector and its in-house technical expertise to design, build, and implement solutions for the evolution of the platform. Incol, as a result, is truly a fintech business. This gives Incol a unique perspective and understanding of the need for and the capability to rapidly deliver accurate, incisive, and timely information. And I'm sure you agree with me that in a global market where mortgages are more transferable than ever between institutions, the need for this type of information for stakeholders is even more critical. With the current focus on ESG by institutional investors and further the questions, as we've seen here in this platform, now being posed by regulators on climate risk management, also accentuates the need for relevant, timely, and dynamic information. Incol Intelligence addresses these challenges for all stakeholders. So Richard asked me a question a few weeks ago, and he said, what problem does our platform solve? The platform solves many problems. Incol Intelligence has many applications, both internally and externally. It addresses many and diversified items. Internally, it eliminates key man risk. It reduces human error and reliance on Excel spreadsheets. It validates a user's data so that it is relevant, complete, accurate, and actionable. It provides the C-suite with a comprehensive, accurate, insightful view of its business that highlights business opportunities and identifies many types of risks. Looking at it from an external perspective, Incol Intelligence prevents unauthorized access to sensitive data. It allows for the portrayal of data externally where it might be used for pledge collateral to the ECB or the Bank of England, securitizations, covered bonds, even forward flow funding arrangements. And it also assists with regulatory reporting. Incol is mindful of the growing need for analysis on climate risk and its impact on business. And with that in mind, we asked ourselves the question, how could the platform help clients address the climate risk within their mortgage books? In that regard, we specifically enhanced the platform's capability to deal with the regular monitoring and measurement of physical risk, energy ratings risk, EPC transition, and green asset ratio. There is no doubt this is an evolving topic, as we have seen here on Let's Greenstorm, and our platform is ready to lead the way. To conclude, Incol Intelligence is of its time, is being built, and is available now. It is scalable, customizable, specific user requirements, and future-proofed. Incol Intelligence has been attractively priced to reflect the size and needs of each business and its stakeholders, and is delivered and supported through a SaaS model. Incol Intelligence is immediately available for use upon signing a SaaS agreement. I'd like to show you a few examples from the platform itself now, if that's okay. So I'm just going to escape here. Can you guys see that? I'm picking the UK for today because it's the actual model I have the most data on, but I can also look at Ireland, Belgium, Netherlands, Spain, Portugal, and Greece. And I hope to add other countries as we go along. So I'm going to highlight here, first of all, give you an overview of how the system works from a stats and strats point of view. And then I'll go into the energy ratings risk, the physical risk, the green asset ratio, the EPC transition, and finally, I will show you how to design a green portfolio from our portfolio creator. So as I said, you simply log in, you pick a list, you upload it yourself. You're faced with a number of dashboards. Actually, in fact, I have 23 across here, so I'm not going into detail that you'd expect me to, because I'll be here for the evening. But you can simply see how the portfolio is broken down, right? It gives you completions, applications, approvals, and rejections. You have geographic distribution by balance, by region. You also have an exceptions report down here showing you from our weighted average min-max tables any exceptions that stand out. Simply by clicking on an exception, you click on the blue line, it brings you to the outliers, and you're allowed to see them from a granular basis. As I said, there's 23 tabs, so I'm just going to pick a few of them. You've got your arrears analysis, you've got balance by region, balance by size, regional overview, index LTV. You can see here how easy it is to view your, well, you might want to view them, but your arrears cases, you can simply click on a given NUTS region and it will highlight the cases that are within that region. Again, you can click on a blue, this blue here, and it'll bring you to the list of granular loans. We also have postcode analysis, which really kind of delves down into the exposure you have from an exposure point of view, or sorry, from a postcode point of view. You have the ability to look at broker exposure. So we've also built in brokers. So that again allows you to individually pick out a broker or look at your top 5. Again, by individually picking out one, everything below the line now is just for this particular broker. We've done the same thing for broker arrears, and we've also done the same thing for underwriter and underwriter arrears. So that's the stats and strats side of the model. I'm going to skip now to show you the energy ratings risk, which is the one I guess you're the most interested in. And what we've done here is we've gone out to our, sorry, I'm just getting kicked out. I've gone out to our data provider. We have given a list of data points to our client. Our client has picked those data points and they've given back to us what they want. We take that data and we seamlessly add it together with the proprietary data belonging to the client. And that allows us then to give an enriched view of the user's current portfolio. And it gives them information that they don't already have for their back book. So I'm going to go into my climate risk management tab here, and it is going to show me an overview of the third-party data that we've brought in to match this given loan book. So here we're able to see the energy ratings across this portfolio. It also shows historically flooded areas. It gives a list of those historically flooded details granularly. It shows potential fluvial flood depths in 30 years, pluvial and tidal. It also shows who's got flood insurance, who hasn't got flood insurance. The energy rating analysis allows you to delve a little bit further and look into those where you have the most exposure if it comes to you having to design a particular green book for a securitization or covered bond or sort of structured covered bond in the future, whatever you want to do. So here it breaks down your energy ratings, and you can say, look, I just want to look at A. So we don't have the greatest example here of a really green book, but there are 9 loans here in this particular book that have an A rating, representing 1.3 million of the overbook, or 11 basis points. Again, you can look at all your energy ratings. Down here, what we've done, put in is a very simple green asset ratio, showing you your EPC rating from A, B, C through to G, and your total percentage and your cumulative percentage. You can say, look, everything from a C rating and above is representative of 24.25% of my mortgage book. Again, by clicking on any of these or a multiple of these, you get a total of what exposure you have from an EPC ratings breakdown. From a physical risk side of things, we're also able to show where there have been floods in the past. And again, there are a summary of the previously flooded properties, in this case 1,700 of them, which is representative just shy of 200 million, what type of loans they were, what type of flooding there were as well. You also have future flood depth, which looks into the future, and it's able to isolate that physical risk for you to look at and isolate further. Also, I can show you the transition. So if I go back up here and I'm going into what this model also does is a time series variance, which allows you to compare, you know, quarter on quarter, year on year, month on month, whatever you want to do. But if I go into my variance model, I'm going to be able to see my EPC transition. So it'll show you over time how your EPC ratings are changing. And what gets measured gets improved, as you well know. So here's a portfolio where I'm comparing, let me see, it is baseline date is December 31st, 2020, with the comparison date, which is the 31st of March, 2021. So the first quarter, it's able to compare and show you the difference between the two portfolios. But what it also shows you is the EPC transitional risk. Now, you're not going to see a huge movement here in one quarter, but you get the gist of what it's doing. It's able to show you the difference between the cumulative energy ratings or measuring one quarter with another. And finally, I'm going to show you our portfolio creator. And our portfolio creator allows you to take that third-party data that you didn't have already and has enriched your book to allow you to come along and design a portfolio that has a green element to it, if that's what you want to do. It does lots of other things. You can take out index loan to value. It has 14 different parameters down the side here. But I'm just going to pick a quarter here. I'm going to go for December 2020. You can see how easy this is to use. From your drop-down box, you pick your particular portfolio and say this is your latest portfolio. What you're doing here is you're coming along and saying, well, look, I've got 7,994 loans, which is 100% of the book, or 1.2 billion is the case it is here. I want to design a book for future. I want to say, look, I just want to see A, B, C, and let's go for D, right? And I want to apply that. So now what it does, it takes out all other loans, loans that have no data, and loans that don't meet the criteria that you've set. You can do that across floodplain analysis as well. and you can do it across loan size, seasoning of months, loan origination date, NUTS regions, type occupancy, interest rate current value, all that type of thing. So now you've gone from 1.2 billion down to 43% of the book, which is 413 million. If you want to keep going from there, you keep going until you design the book that you want. When you're finished, you press this button. It brings you to what I'm calling the Bank of England format here, but it's actually the ECB format as well, and it allows you to export that into Excel or return it for you to have it in the system for future dates. So look, I'm very conscious of time. I'm very conscious that I'm the last speaker today, so I am going to leave it there, and if anybody has any questions, I hope you enjoyed seeing Incol Intelligence and how easy it is to use to take that third-party data and enrich a given book where you don't have that information.
Thank you very much, Frank. I think that what you have shown us is the future, in the sense that all of our banks have to be able to manage their portfolio in such a smart way that they need solutions, and what you are providing is, I think, a very interesting solution. As we speak, I mean, Daniel is, I think, spamming half of the parliament with our position paper on the EPBD. There are some serious concerns of our industry, and also together with the Basel response, we are stating very clearly to the European authorities that our industry is ready to support the transition economy. We want to give constructive comments and critiques to the test that you have seen, because we want to make sure that the mortgage market will be able to support the transition economy, the renovation wave. We need data. We need to have to make sure that the lending capacity will be there, and also that our banks will be able to finance long-term finance their balance sheet with long-term liabilities in the future. So we need more green bonds. We need more green cover bonds. We need more green securitization. We are also establishing an entire, I would say, knowledge platform. We are establishing a green bond task force, which will be very much looking at this issue. And most of the people that have been speaking today, they will be involved in this task force. But also, we are preparing a large global platform to share ideas and content, starting from the 1st of July. So next Friday, the EMF-ECBC will take over the ESMA platform. The ESMA is the International Secondary Mortgage Market Association, created by the World Bank, collecting all the mortgage financing in the world, from Indonesia, from Japan, from South Korea. The EMF is building a network of global stakeholders to tackle together the ESG challenge, social housing, affordability, and we can really make the difference. We really believe that we can help every single family in Europe to reduce the energy cost for 70–80% by making retrofitting. We can support and provide the capital needed for the European economy to make the transition, because we need to make and renovate 220 million of dwellings, which is a huge amount, a huge critical mass. But what we are doing is really changing our life. We are making the next Bauhaus event in Vienna. Tonight, as soon as we close this call, I will go and visiting the place for the dinner of the plenary meeting. We are really re-inviting the entire community to gather and to discuss about these critical moments. And of course, September will be the right moment. But on top of this, we have to be aware that if we don't take action, we really risk to miss our future. I mean, it's interesting to know that, I mean, Indonesia is moving their capital out from Jakarta. They are moving the capital in the north, in a different island, because they know that Jakarta cannot survive to climate changes. So they are investing millions and millions to move the capital outside from the coast and moving this to a different island. We are doing the first ESMA and EMF-ECBC meeting in Venice, just to stress how important is what we are doing. We are creating for the 4th of October a nice conference which will be focused on sustainable housing finance, on how we can build a global alliance to move ESG finance to support the transition. So this will be done not by accident in Venice, because probably our kids are at risk of not seeing the beautiful channel of Venice and the beautiful building of Venice. So we need to take action all together, not only Europeans, but we should build a global network able to change the mentality of people and able to retrofit millions and millions of houses in less than 8 years. This is what we have to do. And I'm very glad that we see a lot of authorities in the call today, because it's a joint effort. We have to work together. We have to understand how the policy framework is changing around us. And we have also the obligation, the moral obligation, to pass message to the European authorities when we see that something is not actually allowing the banks to step in and to move and to support what the European Commission is trying to do. With this, I invite all of you to check our response that will be available online today with all the amendments that we are proposing to Basel and the EPBD. And I invite you to join us in Vienna on the 21st of September, and I hope really to see you all physically with us. With this, I would like to thank the speaker for today, you for following us, and I hope to see you soon, and we wish you a nice break during the summertime, and enjoy your time back with your families. Thank you all, and see you soon.